Here's what's coming up on Beacon Retirement Strategies.
I've had a lot of upset people coming into my office over the last 2 decades realizing that, oh my gosh, I am going to pay taxes again. And it can be on 50% of your Social Security income, but many it's 80% of that is taxed.
We have to have an income plan that is reliable, that's sustainable, that'll take us through a lifetime. We need an investment plan to make sure that there's going to be money there to help fend off rising healthcare costs or just support lifestyle. Taxes need to be considered. Healthcare decisions also need to be considered. And then finally, the estate plan.
So when you consider risk and more conservative investments, if, like this couple that we're mentioning in our example, your ability to take risk was on 60% of your money and you wanted 40% more conservative, there's only so many places that you can put your money.
And now the hosts of Beacon Retirement Strategies, Pete Benson and John Maxson.
Guys, we got a great show planned up for this week.
We do. There's 30 minutes of power-packed information just for you.
So don't go anywhere. The show starts right now.
Today on the Roundtable, very important topic. We're going to be talking about maximizing Social Security. John, it's a one-size-fits-all, isn't it? It doesn't really matter. Just turn it on whenever you want to turn it on. It doesn't really matter, right?
Well, that's kind of dangerous advice, and unfortunately, that's the advice that a lot of people get from their financial advisor around Social Security. Most people think they have 3 choices. I can take it at 62, I can take it at full retirement, or I can take it at 70. It's a lot more complex than that. In fact, if you look at the guidelines, Social Security's got about 2,800 rules that apply to the choices that you have as an individual. And it's not just the income you're going to get, it's the taxes that you're going to pay on Social Security. And Social Security for retirees, even in America today, with pensions going away, is still going to account for, on average, about 20 to 30% of someone's retirement income. So I wouldn't take 20 to 30% of my portfolio and say I don't need a plan. You don't need to do that with 20 to 30% of your income.
I'd say it makes me angry that we're putting taxes and Social Security in the same sentence. Didn't I already pay out on that? Didn't I already pay that? And now I'm going to get it. And am I being taxed again, Pete, for that if I don't do it properly?
I've had a lot of upset people coming into my office over the last 2 decades realizing that, oh my gosh, I am going to pay taxes again. And it can be on 50% of your Social Security income, but many it's 80% of that is taxed. And so, yeah, good planning can possibly reduce that at least. But again, the sooner you start, the better planning you get, and the more of a custom approach, there are ways to possibly reduce that. And then that can affect how much you pay for Medicare, and it's like a domino effect. So good planning, do it soon, and there are ways to maximize. That way you get to keep more out of your money. Hey, it is your money. You put it in all of those years, just like a 401k.
All of those years.
And then your employer also put that money in, just like a 401k or whatever. So what you're withdrawing is your money. I want to get as much of it as I possibly can that's rightfully mine.
Absolutely. And you talk about it being the cornerstone. You've got to get this piece figured out. And John, is it safe to say that if you don't do it correctly, you could not lose, that's not the right word here, but not receive tens of thousands of dollars over the course of your retirement, maybe even a 6-figure number for some folks if they don't do it right?
Absolutely. Not receiving is losing, right?
That is losing. You're right.
And
that
so,
is losing.
For example, let's say that you came to me and full retirement for you is 66 in 2 months. 66 years old in 2 months. But you're 62, you retired, and you need income, so you say, John, I'm just going to turn Social Security on at 62 because it's going to give me $1,500 a month of income. Here's the problem with that. If you take it early, you're signing up for a permanent reduction. We call it a permanent penalty, and it's 25%. It is permanently reduced 25% for the rest of your life. But that's not the only problem. The second problem comes in when Social Security gets taxed. And a significant amount of your Social Security begins to get taxed much sooner because you have a lower income threshold if you take it early, and then for every $2, every $1 and $2 of Social Security gets taxed. If you wait until at least full retirement, or even in 70, you can earn more income and you pay less taxes. So having a plan, making sure that you're able to not put yourself in a position where you're taking a permanent reduction and increasing your taxes for 25 or 30 years is so significant.
Does it matter if I'm earning that income out of my retirement nest egg or if I'm working as far as my Social Security gets taxed?
It's
Does it
the
matter,
working
or
income that
it's
really
the working
is going
income
to,
that really
right.
affects
And a lot of
it
people
negatively,
do
right?
want to and have to still keep working past 62, and so you just got to know the rules
yeah, 'cause
and
the
know.
math-
You know, for your situation, again, we come back, Mark, to that same word, custom planning. And everybody's situation is different. So we want to build around what your needs are right now, what your household looks like, what your health looks like, and are there other pensions? And what if one person's Social Security goes away? How important is it that that other? What's the age difference between spouses a lot of times? They all factor in.
Because there's only 2,700 rules and options,
exactly.
right? That's all.
Just a few.
Pete, John, thanks so much. Hey, are you optimizing your Social Security benefits? Do you want more information on how to do that? Pick up the phone, give us a call right now, or go to our website. And don't go anywhere. We'll be right back.
You're watching Beacon Retirement Strategies, Nashville's retirement television.
You know, John, one of the things I love hearing around our office from clients is that they love the full service, comprehensive approach that we have.
Well, it's been a game changer for our clients and for prospective clients because they can come to one place and meet with all these guys.
Yeah, I've found that clients find a lot of value in the estate planning area, having the opportunity to meet with a tax professional or a financial professional all in the same room most of the time. It allows us to set up a more thorough plan for them.
And they have a lot of questions about health care and that too, Dan.
Now that we have Frankie in the office doing health care, he can do Medicare, he can do standalone plans if you want to retire before the age of 65. That's complicated. There's some great plans out there. A lot of people don't know there are because it's too complicated. Now we have one person in-house that can really research all of those who's fully independent.
You know, the number one thing I'm asked when people come in is, what is a tax-efficient planning strategy? And what I talk to them about is, how do you get some tax-free assets, whether it's Roth conversions, Roth IRAs, other ways of getting tax-free assets. What we're trying to do is make sure that people are able to keep more of their hard-earned money.
How would you like the opportunity of being able to sit around a table in one office and be able to have help all in a good comprehensive plan for taxes, health care, income, estate planning, investments, and all of that? Well, guess what? You can at Beacon Capital Management. Give us a call. We'd love to be able to meet you and help you in any way that we could. 615-436-6000. Give us a call. All of us would love the opportunity to be able to help you and your family.
You're watching Beacon Retirement Strategies, Nashville's retirement television.
This week we're going to talk about how much risk you should have with your portfolio. You know, that's a common question that we get asked as folks come into our office, in particular as they approach retirement or they get into retirement. They'll say, John, how much risk should I have with our portfolio? Now, our common response to that is everyone's situation is unique and different. And that's going to depend on a lot of different things, like how much of your needed income do you get from Social Security? Do you have a pension and things of this nature? But the truth is, there's a pretty simple exercise that you can walk through to really understand how much risk you're comfortable with and what's suitable for your family. So what we tell our clients is they come into our office on a scale of 0 to 100. What percent of your money are you willing to take more risk with? And that is different for everyone that comes in our office. In particular, if it's a couple, usually you'll have one of the spouses that is more aggressive or more growth-oriented and one that's more conservative. A lot of times they meet in the middle. But one of the spouses may say that I want 25% of our money more conservative. Another may say 40. So the truth is always somewhere in the middle. But let's say a couple comes to consensus that they want approximately 40% of their money on the more conservative side of the table. You know, a lot of times our experience is that financial advisors want you and your family to believe that there's some magic investment out there that's going to get you to where you want to be. The truth is, investments are just tools. None of them are right or wrong. They become wrong when they don't fit into what you have as an individual or a family as investment objectives and goals. So when you consider risk and more conservative investments, if, like this couple that we're mentioning in our example, your ability to take risk was on 60% of your money and you wanted 40% more conservative, there's only so many places that you can put your money. So let's talk about that. So if you wanted 60% of your money at risk, where can you put that money? Well, that's where we get into the risk side of the ledger. And the risk side of the ledger is going to include things like stocks. There's a lot of great stocks out there. Some pay dividends, some don't. Then you have mutual funds or exchange traded funds that function much like a mutual fund, but typically at a lower internal cost. Then you have bonds or bond funds. Now, bonds are more conservative securities, but they are in fact securities. And when you talk about bond funds, you've got a couple of things that you may not know about. You have interest rate risk and you have trading risk. Now, again, they are more conservative, but they are nonetheless securities. Variable annuities. Variable annuities, by nature of their name, can go up in value or they can go down. Then you've got things like real estate investment trust and alternative investments. Really, anything that is a security would be what we believe is in a risk category, and a healthy diversification of each one of these or dozens more will really help you get to the answer on how much risk you should have in your portfolio. But let's say you want 40% of your portfolio that is more conservative. You also don't want that money to not be working for you and your family. And much like the risk side of the category, there's only so many places on the conservative side of the category that you can place your money as well. So on the conservative side, you can go to traditional banking institutions and do things like CDs and money markets and checking and savings accounts. Now, they're FDIC insured, they're backed up by the federal government. However, when you consider inflation, they're not going to keep up with inflation with where interest rates are today. Now, that's not to say you shouldn't have any money in a bank. Most people need a bucket of money that's what we call reach out and get money. Money that if you have an air conditioning unit in your home or something like that that goes out, that you can quickly get to liquidity to take care of that for you and your family. But you do have banks. Interest rates have come up a little, but not in a range that we would consider that's going to keep up with inflation. So then you can consider U.S. Treasuries, federal Treasuries. They're more conservative, backed up by the government, and you're going to get a little bit more, maybe 2, 2.25 on these types of things. So we're getting a little bit higher in terms of return, but again, not really in what we would consider a return that's going to keep up with inflation. You can go to things like fixed annuities, and fixed annuities function much like a bank CD. However, they're not FDIC insured. They're backed up by the paying ability of the insurance company that your contract is with. But nowadays, we're seeing fixed annuities in the range of 3 to 3.5%. So that might be a consideration. And then finally, in addition to many others, there's what we call a hybrid annuity or a fixed indexed annuity, which is principal protected, and it goes up if the market index you're relying on goes up, but it is subject to a cap, but it's principal protected. So getting a healthy balance, depending on what your risk tolerance is across the board of these and many other investments, is how you can have confidence that you have the right risk profile for you and your family. Well, if you have questions about any of these topics or would like more information, give us a call in our office or go to our website.
Your tax tip for this week involves a comparison of a tax preparer versus a tax advisor. I get asked this question a lot. All tax professionals are typically viewed as tax preparers, and while there's some truth to that, it doesn't tell the full story. Here are some of the qualifications and skills of a tax preparer. Their primary focus may be on events that happened in the past. They gather appropriate personal information from clients regarding income and deductions, and their main responsibility is to prepare and submit an accurate tax return. A tax advisor can prepare tax returns, but we provide many more services to our clients. Some of the additional services are meeting with clients and financial advisors to identify tax planning opportunities to minimize long-term taxes, such as managing your tax brackets now and in the future, Roth conversions, life insurance alternatives, and other tax-efficient strategies. Long-term tax planning also includes meeting with clients and understanding legacy aspirations and the potential tax impacts these may have. If you think your tax preparer isn't qualified enough, I suggest you come and talk with us at Beacon about tax and financial advice. That's your tax tip of the week.
You're watching Beacon Retirement Strategies, Nashville's retirement television.
It's your retirement. How will you live it? How will you be remembered?
Will you be able to take me on vacation? Will you be there for my ball games? Will you teach me your values? You'll be able to play with me. Oh, help me go to college. How will I remember you?
It's time for a reinvention. It's time to write new chapters in our life stories. Every story includes a middle, where important events unfold. A second act, if you will, where characters learn more about themselves, where people discover how truly different life could be. A reinvention, a retirement. It's time to turn your hobbies into creative businesses, to volunteer using skills gathered across a lifetime, to hit the open road in search of new horizons and fresh faces. It's time to grab those grandchildren and hold them close. Grand adventures. Or simple pleasures. Today's retirement is different. It's not the final chapter in the book of life, but rather a new beginning. A second act.
You're watching Beacon Retirement Strategies, Nashville's retirement television.
Hi, and welcome to this week's AskBeaconNow.com, where you email your questions into us, and we answer them right here on the show. Dan, are you ready?
I'm ready, Mark.
All right, my first one is from Robert in Murfreesboro, and he writes, I have 3 401ks sitting at my old companies, and a 4th at my current company. I'm 62 years old, and these 4 401ks represent all of my retirement savings. I'm looking for some ideas on how to position myself for retirement. Help.
Sure. Thanks, Mark, for the question. And at 62, surely you're getting close and kind of rounding third base when it comes to retirement. And so you're none too early to start looking at what should the retirement investment portfolio look like. Here at our firm, we do all of our planning really starting with the foundational principle of income. We want to make sure that your income is secure, that we know that the amount of money that you want coming in to support your lifestyle, that we have a plan for that. We have a written plan that takes you from now all the way till the retirement date and up till age 100. And I would say that you want to start by sitting down with someone that does full service, comprehensive planning, financial planning, not just investment planning, but that can really start developing a plan to prepare yourself for the income. That may begin with consolidating a lot of these accounts into one place so that you can start positioning yourself now in anticipation of the income that you're going to need in retirement. And so sitting down with an advisor that can give you all of those pieces regarding income, taxes, Social Security even, and then the investments as well would be the place to start.
You know, Dan, I'm going to just piggyback on that because so often, and most of the shows, we talk about the Beacon Retirement Blueprint. I think this is a great opportunity, not just to let Robert know, but all those folks viewing of the magnitude of this written plan that you guys create, which is really proprietary for Beacon.
Well, it is, Mark, and it covers what we feel like are the 5 bases that everyone is going to face in their retirement. One of those being the pillars being income. We have to have an income plan that is reliable, that's sustainable, that'll take us through a lifetime. We need an investment plan to make sure that there's going to be money there to help fend off rising healthcare costs or just support lifestyle. Taxes need to be considered. Healthcare decisions also need to be considered. And then finally, the estate plan. And so our blueprint really covers all of those bases. And we have all of those pieces and all those experts there in our office that can sit down together with you to make sure that everything is cohesive when it comes to the retirement plan. And you're not having to go to 5 different places to try to rush to get something done. We want to take our time, do it right. And that's why we have all those resources here all under one roof.
Thanks, Dan. My next question is from Mandy in Franklin, and she writes, I'm trying to figure out if we can retire. We are both in our early 60s, and we were wondering if $350,000 is enough to retire on today. We are not big spenders, and we're willing to make changes in our lifestyle if necessary. Thoughts?
Well, one thing, congratulations, Mandy, on the upcoming retirement, and hopefully you guys will get there very soon. $350,000, the number itself really isn't relevant in my eyes in whether you're going to be able to retire. There's a much bigger picture here. We have to take into consideration many other pieces regarding income, debt, expenses. And the one thing that I would encourage you to do, I know you're willing to make some lifestyle changes to be able to retire, but me personally and a lot of the clients we work with, they didn't work 35 to 40 years to get into retirement to immediately start tightening the belt. And so what we want to make sure is that your income is going to be sufficient and that the investments, regardless of the amount, whether it's $350,000, $100,000, or $2 or $3 million or more, it's not the number that matters, it's the plan that supports it to make sure that we're going to be able to cover all of the things that you want to do. All of that begins with a plan and sitting down and having a conversation. The fact that you've called in is the right first step. The next step is to follow that up and make an appointment with somebody to go in and actually sit down, have a conversation with them. We'd love the opportunity to meet with you and your family and really, unpack this conversation a little bit more. And again, Mandy, thank you so much for your question and look forward to talking to you soon.
Dan, thanks so much. And I want to thank Robert and Mandy for those wonderful questions. Hey, if you want your question answered here on the show, we know you have questions about retirement, and we'd love to get back to you on it. Hey, go to askbeaconnow.com, email those questions in, and we will get back to you on those. And don't go anywhere. We'll be right back.
This week we're going to be talking about gift taxes. Many people wish to make gifts to individuals or loved ones during their lives, but are concerned with any gift tax consequences of doing so. For most people, there's no need to worry. If you wish to make gifts to children, grandchildren, or other family members, or even friends, the IRS allows you to gift up to $15,000 per person each year. If you're married, each spouse can give as much as $30,000, so you can double that. So for example, a married couple, you could give up to $30,000 in 2020 to a child or grandchild or even a family friend. These gifts can also be outright or gifted in trust or in a 529 plan or a uniform transfer to minors account. It doesn't matter. You can leave it in a number of different ways. Now, many people aren't aware that you can actually gift more than an annual gift tax exclusion, so more than that $15,000. If you plan to give more than $15,000 in any particular year, you want to make sure you work with your estate planning attorney and accountant because the filing of a Form 709 gift tax return may be required. And that's your estate planning tip of the week.
You're watching Beacon Retirement Strategies, Nashville's retirement television.
Having no clear retirement plan is a mistake I see a lot in my financial planning office when I meet with someone new. It is extremely rare that someone comes in and has a clearly defined income plan for his or her retirement. One way you'll be able to get a clearly defined income plan is to talk to an independent financial advisor who specializes in retirement planning. Not someone who is specialized in getting you to retirement, but someone who is dedicated to getting you through retirement. If you don't have a clear retirement plan, then be one of the first 5 callers and you will receive a free complimentary planning review. There's no obligation, no cost if you have at least $200,000 saved for retirement. Here's what you'll receive: a free report to sort through your current fees, a tailored plan to help protect your investments, a tax analysis to reduce your tax liability and increase your cash flow to your family, and a custom income plan to support your lifestyle. So call now for your free, no obligation Beacon Retirement Blueprint.
You're watching Beacon Retirement Strategies, Nashville's retirement television.
Welcome to this week's Masters Money Moment. This week we're going to talk about the importance of protecting your assets. You know, the world seems like it's a crazy place. A lot of times people will come and ask us about different things that are happening in the United States and around the world, and they're really fearful. Well, first and foremost, we do want to be prudent, but we don't want to live our lives in fear. We should never make decisions along those lines. The Bible actually has something to say about protecting your assets as well. Proverbs 27:12 says this: "The prudent sees danger and seeks refuge." So we do want to be prudent in a world that can sometimes be out of control. That's something that we talk to people about, but we don't want to make decisions out of fear. We want to be prudent. We want to understand what's happening to the best of our ability, and then we want to make decisions that are based on things that we know, not things that we fear. And that's this week's Masters Money Moment.
You're watching Beacon Retirement Strategies, Nashville's retirement television.
Are you worried that your financial strategy is missing something? Today's retirees and pre-retirees will need to utilize the services of a qualified legal and tax team, as well as a financial advisory firm. The professionals at Beacon Capital Management, Beacon Accounting and Tax Services, and Knight Legal are committed to being your comprehensive wealth and retirement planning solution. And here's the best part: all of these services are under one roof. That's right, let Beacon Capital Management effectively coordinate all of your retirement, legal, and tax planning needs. Our unique combination of licenses, registrations, and specialized education qualify us to work with a wide variety of investments. We can create a solution for virtually every retirement scenario, no matter how simple or complex. Call us today and experience the Beacon difference. Imagine all of your investment, tax, and estate planning questions being addressed around a single table. Call now for a complimentary retirement analysis. There's no cost and there's no obligation as long as you have saved at least $200,000 for retirement. Call us now, and remember, at Beacon Capital Management, peace of mind in retirement requires a plan.
You're watching Beacon Retirement Strategies, Nashville's retirement television.
Hey guys, great show this week. Thanks so much for tuning in.
Yeah, and if you'd like more information, give us a call at the office or go to our website.
And remember this, peace of mind in retirement requires a plan.